Smart finance moves. Insight from CS and IP.
Welcome back to IPO Insider. In today's episode, we're exploring the different categories of IPOs and their significance for investors. We'll provide a detailed analysis of the key aspects, including costs, risks, time, returns, and tax implications to help investors make informed decisions. Let's dive in. The fixed price IPO is the traditional model where a company offers shares at a set price. Investors benefit from knowing the exact cost up front, which can help in planning their investment. However, the risk lies in the possibility of demand fluctuations post-listing. The decision-making process is time-sensitive, as the fixed price remains constant during the IPO. Returns from fixed-price IPOs tend to be stable, making them a preferred choice for conservative investors. On the tax front, long-term capital gains tax applies after 1 year, offering potential savings for those who hold their shares. A book-building IPO, on the other hand, introduces more flexibility by offering a price range. Investors bid within this range, with the final price determined by demand. While this offers more opportunities, it can result in higher costs for those caught in competitive bidding. The risks are tied to market demand, which can lead to price volatility. Investors benefit from potentially higher returns in high-demand IPOs, but unpredictability is a factor. Taxation remains similar to fixed-price IPOs, making it essential for investors to plan for long-term holdings. The Dutch auction IPO operates differently by allowing investors to submit bids at different price levels. Shares are allocated based on the highest bids that meet the company's reserve price. This model requires strategic bidding, as prices vary with demand. The risk is notably higher due to market sentiment fluctuations, and the process often takes longer due to its complexity. For those who strategize well, returns can be substantial, but there's a risk of overpaying. Tax implications align with standard IPO rules, but investors must carefully assess the potential gains and risks before participating. A direct listing IPO bypasses raising new funds by listing existing shares directly on the stock exchange. This method is cost-effective for companies, but for investors, the pricing is entirely market-driven, making it highly volatile. The time to market is quicker, but investors face immediate fluctuations without the price stabilization typically provided by underwriters. Returns can be significant, particularly if the stock performs well, but the volatility demands a high-risk tolerance. Tax treatment follows standard rules, but timing the investment is crucial to optimize returns. The Special Purpose Acquisition Company, SPAC, IPO offers an alternative approach. SPACs are shell companies that raise funds to acquire a target company, taking it public without a traditional IPO. Investors often encounter lower entry costs, but must consider the risk of dilution due to the SPAC structure. The timeline is faster than a traditional IPO, but it requires patience for the acquisition to finalize. Returns can be lucrative if the SPAC identifies a strong target company, but success depends heavily on the target's performance. Tax implications can be complex, necessitating careful planning. Lastly, SME IPOs, small and medium enterprises, cater to smaller businesses and are listed on specialized platforms such as NSE Emerge or BSE Ascent. These IPOs are appealing for their lower entry costs, but investors face higher risks due to the smaller scale and market volatility of companies. SME stocks may require more patience, as their growth trajectory can take longer to materialize. Returns have the potential to be significant if the business successfully scales, but this requires thorough research and risk tolerance. Tax rules are similar to other IPOs, but professional advice is recommended given the niche nature of these investments. Each type of IPO presents a unique mix of costs, risks, and potential returns. For investors, understanding their financial goals, risk appetite, and tax implications is essential to crafting a strategy that aligns with their objectives. If you found this video helpful and want to continue enhancing your investment knowledge, make sure to subscribe to our channel and hit the notification bell so you don't miss any updates. Stay tuned for our next videos. Thank you for watching, and happy investing.